Right. Welcome to the Chapter 6 desk lecture. I'm going to go over basically merchandise inventory. So this might feel a little bit familiar to you, especially as we start, because Chapters 5 and 6 really do kind of go together. They're very separate in terms of what we're doing, but they're very combined in terms of that we're dealing with what companies do that have inventory. And that's all the journal entries you did in Chapter 5 were the journal entries associated with that inventory function. And now in Chapter 6, we're going to kind of see what's going on behind the scenes and what's kind of going on behind some things. So we're going to first talk about inventory relationships, and really this is a refresher slide from what we talked about in Chapter 5. We're going to talk about a couple of inventory issues up top, and then we're going to get into what inventory costing is, talk about our different ways to kind of calculate inventory, and then at the end we're going to kind of grab a couple things we need. So we're going to do like a couple of short issues in the front and the back, and then covering the more substantive inventory costing issues in the middle. So this is a review slide from Chapter 5. I'm not going to take as much time as I did in Chapter 5 on this. If you want more time with this, go back to Chapter 5. But basically, these are relationships, and you're going to see this start to play out a little more in this chapter. The beginning inventory plus purchases is goods available for sale. And then we've also got the rest of that, which is our goods available for sale minus ending inventory equals cost of goods sold. I could have also added on this slide that ending inventory plus cost of goods sold equals goods available for sale. That's obviously something algebraically we can do also. So a couple of inventory issues to talk about. The first is reminder free on board, means ownership transferred. Again, I talked about that in Chapter 5 also. Just wanted a little reminder on that. I wanted to hit a little bit, just briefly, on the kinds of accounting 1212 inventory types. They're discussed in the textbook, and I just want to kind of mention them. When you move on to 1212, you're going to see three types of inventory discussed, and this will be early on in accounting 1212 if you take that class, which are raw materials, work in progress, and ending inventory, and finished goods. Raw materials, work in progress, finished goods. The example that I like to talk about is, like, imagine you're at a pizza place where you walk in. My kids love Domino's, so when we go to Domino's, they love to like sit there and watch them make the pizza. So if you walk in and you see like a bag of cheese or a bag of whatever stuff there is, that's raw materials, and nothing's happened to it yet. As soon as they get the dough and start to spread it out and start to put stuff on it, tomato sauce, cheese, whatever, during that process, it's a work in progress or work in process. And obviously, once the pizza's out and cooked and in the box and ready to get picked up, that's when it becomes a finished goods. Also, another type of inventory that you might need to be familiar with for quiz, etc., is consignment. So you may have heard of a consignment shop before, but a consignment shop is a place where they sell other people's stuff. So if you have a piece of furniture and you don't want to sell it at a garage sale, you might go to a consignment shop in your town and say, hey, I've got this piece of furniture, I want $200 for it, and then they put it on their floor. Someone comes and buys it, and then the consignment store gives you the money. During that process, though, they don't own that inventory. That's why it's relevant to this chapter. It has to do with the ownership of the items. All right, so let's talk about what inventory costing is and why we care about this. So here's our first scenario. So imagine this is a scenario. We've got a beginning inventory of 10 units and $10 when the month started. February is the example here. We made a purchase during the month for 15 units at $12. We sold some stuff. We sold 18 units for $26. We buy some more stuff, 12 units for $13, and then we make another sale, 15 units at $27. So our journal entry for February 15th, and this is a review concept. If you have considered Chapter 5 and are good with Chapter 5, then this journal entry is pretty easy. We bought 15 units for $12, and so our entry is a debit to inventory and a credit to accounts payable for $180. What about our journal entry for February 18th? Again, a review-ish question. The first part of this entry, we got this. This is exactly what we would have done in Chapter 5. Debit to accounts receivable for $468, which is 18 times 26. A credit to revenues for the same amount because we've sold the product. But things get tricky when we get here, right? What do we put in the second part of our entry based on this scenario? Well, you can see I sold 18 units. But which 18 units did I sell? Did I sell some of these and some of these? Or what units did I sell? That is the question this chapter is answering, which is how are the different ways that a company is allowed by GAAP to record or assume that inventory was sold. The first one of these is going to be FIFO. First in, first out. So this is our first inventory cost assumption. So we're going to answer the same question. which is what goes in this journal entry, using the assumption that the first ones in are the first ones out. So here we sold 18 units. So where did we get those 18 units from? Well, we sold 10 units from 10, which is the first part of our thing here. And that's only 10 units though. We sold 18. So 10 of them came from our beginning inventory. The other 8 came from this purchase on February 15th. And so I go from 15 units down to 7 units. I sold 18 units on February 18th. 10 came from here. 8 came from here. That's 18. I'm good. And my cost for those 18 units is $196. 100 from the beginning inventory, 96 from the purchase on the 15th. So this is what my journal entry would look like, assuming FIFO, assuming the first ones in are the first ones out. A couple things I want to mention before I move on. The way I approach these problems is distinctly different than the way that the text approaches these problems. The text approaches these problems with kind of a table that kind of flushes out and kind of unfolds and develops. It's kind of a big process. Like literally, I'm holding my hands apart pretty big right now in my office. It's a big process. It takes up some space. And so I don't use that to teach it for a number of reasons. But if you like that presentation, if you look at the presentation of the way it kind of unfolds on the page in the textbook, then that's what you should use if you like it. You'll get the same answers either way. It's just a matter of how you want to approach and kind of go after the answer. So back to this. Sorry, one other thing. The most important thing you have to do when you're doing these problems is you have to retain the information. And so I can tell from looking here that these 10 units are gone and these 15 units aren't 15 anymore. I've got 7 left. You've got to somehow document on your paper as you're doing your worksheets or your homework how many units are left in an individual category, and you'll see why in a second. Because what happens is February 25th rolls around. We have another sale. We have a sale for 15 units. Again, assuming FIFO, which units did we sell? We sold 15 units. Well, we're going to start by selling these 7 units. 7 times 12 is $84. But that's only 7 units. We've got to sell 8 more. And of course, it's pretty obvious looking here where they came from. These are all gone. These are all gone. We've already sold those, obviously. And so these are where the other 8 units come from. And so we take the 8 times the 13 from where these came from, add it to the 7 and the 12 where those came from, and we get a cost of goods sold for the February 25th sale of $188. And another thing you'll note here is this number here. We have 4 units left at the end of the month. And we're assuming, because the first ones in were the first ones out, that these are the units that are left. Whenever I approach a problem like this, whenever I approach a inventory cost assumption problem, FIFO, LIFO, weighted average, what have you, I always start by answering this question first. What's the goods available for sale? And I'll show you why in a second. And again, this is kind of reason why I talk so much about those inventory relationships early on in this chapter and in the last chapter. No homework problem or exam is going to ask you for that goods available for sale number, but it's going to help you every time you do one of these problems if you choose to let it help you. So in this case, my goods available for sale is my beginning inventory, which was 100, plus my 2 purchases for $180 and $156, leaving me to a goods available for sale of $436. I can also add the 2 cost of goods sold numbers I just calculated on the previous slides. So I calculated $196 from sale 1, $188 from sale 2. That gives me $384 in total of cost of goods sold. And remember that those 4 units that we had left from the February 22nd purchase, well, that's my ending inventory. My ending inventory is these 4 units times $13 or $52. Now, before I finish up and kind of send you on your way to work on your first worksheet, I want to point out this number, why this number is so helpful. We just went through and calculated cost of goods sold and ending inventory. The first time you do these problems, it might take you 5, 10, 15 minutes to do this. And before you start looking at the solution and figuring out what you did wrong, what I want you to do first is I want you to calculate goods available for sale, and then I want you to calculate cost of goods sold, and then calculate ending inventory. And then you add up these 2 numbers. Add up the cost of goods sold, add up the ending inventory, and you'll see every time you do the problem correctly, they match the goods available for sale. This isn't a guarantee. There are ways to make this happen, to have the goods available for sale equal the beginning inventory, equal the cost of goods sold and the ending inventory, but it's not very common. If you're doing the problem correctly, this will catch any numerical mistakes, calculator mistakes, anything like that. So this sends us right into worksheet one. Worksheet one is a FIFO inventory cost assumption worksheet. It's got very similar to what we just worked through. It's got a beginning inventory, it's got 2 purchases, it's got 2 sales, kind of split up. Take a shot at that worksheet. When you're done, take a break, do something else, come back, and we'll talk about LIFO.